Happy New Year, and thank you for joining me for the first edition of the Mortgage Machine Minute for 2011, brought to you in glorious high definition using the Cisco Flip camera. I'd like to give a quick shout out to my friends Barb and Evan for letting me use this unique gadget. On Monday, January 17, 2011, the Canadian government came out with changes to residential mortgage rules to curtail soaring household debt in this country. Three of the changes that were enacted are the reduction of the maximum amortization of your mortgage. You can only now amortize your mortgage up to 30 years instead of 35. Another change that they came out with was the maximum amount you can refinance your mortgage is to 85% of the appraised value instead of 90%. Another change that they came out with is they've withdrawn their insurance to secured lines of credit or home equity lines of credit that are secured by your property. So what does this all mean to you? Well, the first change will have a big impact on first-time homebuyers and those homeowners that would like to refinance their mortgage to improve cash flow. A 35-year amortized mortgage will have a lower monthly payment than a 30-year amortized mortgage. Here's a quick example. Let's take a $250,000 mortgage at prime, which is now 3%. With a 35-year amortization, you're looking at a monthly payment of $960. Take that and move it into a 30-year amortization, and that payment increases to $1,052 a month. That's almost $100 more a month. If you're looking for your first home and just starting out, that $100 could make a huge difference in your budget and may even disqualify you from actually getting the mortgage if you don't have sufficient income. The second change will have more of an impact on current homeowners. Right now, you can refinance your existing mortgage up to 90% of the appraised value of your home. As of March 18, 2011, when these new changes take effect, you will only be able to refinance your mortgage up to 85% of the appraised value. Consumers that were planning on turning that equity into cash for whatever reason should make note of this change and either refinance now or adjust your financial plans to accommodate the lower loan-to-value. In plain English, you'll basically be allowed to take out less equity from your home. Another major change to the rules is as of April 18, 2011, the government will no longer offer insurance on secured lines of credit or a homeowner's line of credit. So that means that if you were going to take out one of these lines of credit, you can go up to a maximum of 80% of the value. It has to be a conventional line of credit. So again, you as a homeowner, if you were planning on turning that equity into cash, you'll need to adjust your plans accordingly or take out that line of credit now before April 18th. These changes may seem negative on paper, but in my opinion, I believe they'll bring stability to the Canadian real estate market and help us avoid problems like our neighbors down south are having. Basically, the government's telling you that you should only buy a house that you can afford, which seems logical. If you have any questions about these new mortgage rules or any other mortgage-related questions, please email me directly at duran_levy@centum.ca. I appreciate all your comments and feedback. Thank you for watching this episode of the Mortgage Machine Minute, and we'll see you next time.